The broadcast is now starting. All attendees are in listen-only mode.
Hey, folks. How's everybody doing out there so far today? Kind of a rainy day here in Arizona, so pardon me if you guys start hearing the rain because I got a skylight here, and when it rains, the raindrops are about that big here. You'll start hearing the thumps. How doing, D? Good to see you back. Yes, I need a haircut and a shave. Definitely need a shave. Trying caffeine overload for you guys to bring the heat. All right, who out there thinks they've got the furthest away from Scottsdale, Arizona? Who out there thinks they've got the furthest distance? Nobody? Everybody from Scottsdale? All right, quiet crowd today. Boston, all right. Dan's got it with Boston so far. The winner, you get a cookie. You just got to come here to get it, though, Dan, all right? So next time you're in town. Double chocolate chip. No, I've got my wife's mother has a cookie recipe that is to die for. I mean, if you like like a an English toffee in your cookie, it's yummy. All right, let me get this set up to record and we'll get started. But I'll get you a double chocolate chip. All right, I'll set this up to record and we'll get started if I can figure it out. There we go. All right, folks, this is being recorded. Something I mentioned at the beginning of every single webinar is watch it again. You don't have to watch this particular one on the roadmap, but one of my short put butterflies. Why? Because if you're newer to options trading, you're newer to the way I teach, I have specific guidelines that we need to follow in order to implement any strategy. And one of those things with the short put butterfly, it kind of flies in the face of all of that. And we'll go over when we break some of those traditional rules. If you've watched any of my other webinars, you've heard me say like 99% of the time, this, that, and the other thing. Well, this is that 1% of the time when we're talking about butterflies that we start to break some of those rules, it feels like, but I'll show you why it kind of flies in the face of all of that as we go through this webinar. So, like I mentioned, this is on the short put butterfly, but let's get a couple of things out of the way really quickly. Just to introduce myself, my name is Eric Wilkinson, and some of you may recognize me from CNBC, Fox Business, or any other mainstream media for my commentary on everything from economic to geopolitical and market analysis. I started trading in college with some money I'd earned about 27 years ago, and after graduating, moved to Chicago, started trading on the floor of the Board of Trade. And in that time, I've traded everything from stocks, commodities, futures, financial futures, currencies, and options on all these products in just about all market conditions. So without that further ado, let's get on with it. This is the short put butterfly. One of the things I want you to do is take this idea and put it on the shelf for a little bit, because who goes into the day, like, did anybody walk into today and think, God, I need to put on a short put butterfly? No, what happens is we come up with a directional assumption, and then we need to look at what's going on around that underlying to find the optimal strategy for your given assumption. And we'll walk through that as we go along here, though. But a couple of things you're going to learn today is when we come up with a direction, if we have a directional assumption, the next things we need to really look at is, do we have a good destination? I'm going to talk about that. That really is the underlying that we're talking about here. And is it tradable with options? Because there's a lot of big names out there, say for instance like Aon. It's not going to really fit my rules for trading options around it. The option montage or the bid offers in all of these strikes just doesn't follow through with it. There's just not a lot of people, because there's not a lot of people trading options around Aon. It's just, yeah, it's not sexy enough. Anyway, the environment. This is when we're going to be talking about implied volatility. All right. So destination is the stock tradable? Stock options tradable. All right. Can we trade those? The duration. We're going to be talking about days to expiration. What is the best days to expiration for this specific strategy? As we go through it, we'll figure all that out. And most importantly, we're going to be talking about strike locations. I'm going to give you guys some simple tips in order to find quickly the right strike location for this strategy. Now, you can go online and read about the short put butterfly, okay? They're going to give you basic guidelines, but they're not going to talk about specific strike locations. How much of a credit should you be receiving in order to do that? What's your risk reward? Those are things that I find are very, very important before putting on a strategy, right? We need to know that the risk reward is optimal for putting on a strategy. And people out there, I've seen them even in courses that I've done, or when I've joined other people for different seminars, I should say, set this strategy up out of the money sometimes, and thinking that the underlying is going to make some kind of move and outpace that. It just doesn't make sense. Your reward is so little compared to your risk in a location like that they will talk about, that it doesn't make sense. So we're going to talk about specifically the location of these strikes to make it worth our risk. All right. So a couple of things though, we're talking about the roadmap. We need to talk about the roadmap key first in order to understand what this roadmap is telling us, right? When you're looking at a roadmap, you need to know if you're looking at a blue line, is that an interstate or is that a side road? You don't want to be driving on a dirt road cross country, right? So we need to understand our roadmap key in the option montage in order to understand what's happening to all of these premiums that we're going to be looking at around these strikes, okay? And it'll make more sense. I'm going to try and beat this like a dead horse till you guys get it, right? But delta, what we call this is data. And it's going to tell us a lot of different things about that strike in the option montage. But most importantly, right now, I want you to understand that delta affects that option premium in relation to the underlying. And we're talking about that first dollar move. And when we're talking about these Greeks, and I know some of you guys are like, oh my God, he's not going to talk about Greeks. Yes, I am. And I'm going to show you guys simple ways to understand and remember what these Greeks are telling us, okay? And with that being said, delta, and gamma and Vega and Theta, the one assumption we need to go into this knowing is that they're assuming everything is moving up, moving forward, moving higher, okay? So it's an advancement. We're not talking about back stepping, okay? So the assumption with the option montage, when we're looking at all these numbers, just know that it means for the advancement. And so what we're talking about here, if we look at the option montage of anything, it could be any stock, and I'm just going to call it XYZ. That's why I blocked it out there, because it doesn't really matter what this underlying is right now. All right, so if we're looking at the calls and the puts, we've got the calls over here, we've got the puts over here. In the option montage, we're talking delta, and this is when the underlying moves higher by $1, right? An advancement. So now we're talking about 149.35. So we've moved $1 higher. All else being equal, I'm trying to isolate this just for this these examples. So if we moved higher by $1, these premiums over here, let's just call it the 150 strike, these premiums over here are going to increase by the corresponding delta. So, for instance, if we moved higher by $1, we could assume that our premiums would then be $4.05 and $4.20 on the offer, right? Because now the bid increased by 45 cents, the offers increased by 45 cents. Now, on the flip side, we're going to be talking about delta on the put side also. Well, think about it. If it moves higher, our premiums are now having a negative delta. All right, so if we move higher, our premiums are going to decrease by that 38 cents. All right, so we could see that these would then end up being $2, and let's call it $2.62, right? They would decrease and be $2.62 on the bid and decrease by 38 cents there, and we're talking $2.72, right, on the offer. So they would decrease by that corresponding delta if we had moved higher. If we moved lower, all right, math principles going into this, we move down by $1, we have a negative move. That makes that a negative delta, right? A negative plus a positive makes that a negative. And on the delta side for the puts, a negative dollar plus, or a negative move plus a negative delta makes that a positive delta. So if we start moving down, those deltas become positive to the premiums. All right, and that's just on delta alone. And then if we look at gamma just goes with delta. All right, so you can think of gamma goes with delta, and gamma goes with delta on dollar number 2. All right, so dollar number 2. First dollar, delta affected our premiums. Well, delta is still going to affect our premiums on the second dollar move, but what happens is gamma goes with delta on that second dollar move. So if we go back to this page, we can see the gamma column right here. All right. So first dollar move, we went to 149. Now we're talking about 150.35. So this is on our second dollar move, right? We got to start thinking about gamma. So that second dollar move higher, gamma goes with delta. First dollar move, we had 45 cents. Now we're going to have 48 cents going into those premiums. All right. So then we'd be, $4.53 on the bid, and then $4.68 on the offer. On that, that's what we can assume our premiums increase to on that second dollar move higher. Now, if we move $2 higher, we've got gamma over here. It's always positive. Well, negative 38 plus a positive 3 means 35 cents. So we would lose 35 cents out of these premiums on that second dollar move higher. Again, if we went down, right, $2, this gamma would go with the delta, and we would have a positive 38, right, because we moved down by $2, positive 38 plus the 3 cents, we would be looking at 41 cents going into those premiums on a second dollar move down. Okay, you guys all following me so far? Theta's the thief. All right, the thief in the night, because every night theta erodes those premiums, or that thief. Now, something to note about the thief. the closer and closer we get to expiration, this thief is going to be more and more aggressive. Further out in time, he's a little bit less aggressive, all right? He's kind of like, all right, I've got a lot of time. I've got to maybe hit some of these other houses before they move, something like that. You get the drift. But the closer we get to expiration, the thief really starts picking up steam and impacting those premiums by the correlating theta. Now, if we're going back to this same option montage, it would be 1 day later, so there would only be, say, 35 days left. Well, theta is always negative on both sides, call and the put. Why? Because we can't go back in time, right? You can't go back in time, so it's always eroding. Now, you can take advantage of theta, right? Sometimes if you sell high and buy low, that's a good thing. Well, if you sell high, you want theta to start eroding those premiums. Like if you collect a credit, anytime you collect a credit, you want theta to be on your side. You want this number to start increasing. And the closer and closer we get to expiration, especially inside that 7 days to expiration, theta is like maxing out, all right? So go 35 days to expiration is kind of the sweet spot to get involved into a strategy. And then that theta starts picking up steam every single day, all right? And it starts eroding at those premiums. So tomorrow you would wake up and would lose 6 cents out of the calls and the corresponding puts that we were talking about. And obviously you can see that the at the monies here and the at the monies here have the highest theta decay, right? The at the monies have the highest theta decay. So something to keep in mind. Closer to expiration, theta really starts picking up. The at the monies are affected by that theta more so than what we would see out further away, okay, in the money or further away out of the money. So the thief in the night that comes and steals our premium. Theta's not so aggressive, way out in time. And then we got Vega. Vega is actually the only one that is not a Greek, and it's actually the one that's the most important in my eyes. It really is the thing that's going to determine any option strategy, okay? And I'll show you how that works out as we go along, but Vega is just volatility, and more specifically, it's implied volatility. It's not historical volatility. It's not the VIX. What we're going to be looking at is Vega for that underlying, and that's implied volatility. So when we're looking over at the over at the option montage, this is Vega. It's just implied volatility. All of these numbers are implied volatility, and same on this side, right? Notice Vega is positive. Why? Because it's the advancement, right? So going up, if we were to increase to 27.57 in implied volatility, and that's just 1 percentage point, you guys. 1 percentage point is a very small move in implied volatility, believe it or not. You can see implied volatility jump or drop 5 percentage points in a single day, especially in this 2020 type environment. So volatility will constantly flux. What we want to try to do is, if you're buying, you want to get it when it's low IV, and when you're selling, you want high IV. Why? Because implied volatility is really the thing that's going to affect these premiums at any given day, probably more so than just about anything else, right? So when volatility increases by 1 percentage point, all else being equal, the underlying didn't change a penny. We could see that this Vega coefficient will then add into the premiums, right? If volatility starts going down, that puts it as a negative 1 percentage point. Well, that would make these Vega coefficients negative, right? So as volatility would decrease, we would see that Vega number become a negative and subtract out of those premiums, right? Pretty simple. Did I make that a little bit more simple than what you were normally accustomed to? Did that clear anything up? Make it more foggy? Please feel free to reach out with questions at any given time, you guys. I'm constantly trying to look over there and make sure everybody has clear concept before we move on. So theta is the thief in the night that comes and steals your premiums. Sometimes you want it, sometimes you don't. Volatility, you need to know what this number is for any particular underlying, all right? Every underlying has a different implied volatility range that it has. You know, Tesla, you know, this Tesla would probably never get down to 26, all right? So we need to know what XYZ's implied volatility is, all right? I'm not worried about VIX or any of those other things. Specifically, we're talking about that particular underlying. How doing, Alexander? All right, so short put butterfly, you know, you go online, they're just going to tell you to do this, all right? You know, you buy, you know, you're buying 2 of these, buying, selling, all right? There you go. There's your put butterfly. That creates a short put butterfly. You're on your own. You just turned from a caterpillar into a butterfly and you're flying away. No, we're gonna figure out exactly what that means. I'm not gonna leave you hanging with that. But for right now, let's put all of that on the shelf. The short put butterfly, because what we're do on a given day, we go through the charts, right? Come up with a directional assumption. Maybe you found your directional assumption online somewhere, or reading a news article, watching mainstream media, you know, for an assumption. There goes my pen. I got another one. Not my favorite one, though. Where are we going? So we kind of look at a chart, right? We're looking at Facebook, and I see Facebook's kind of breaking down. I'm listening to the news today, and, you know, they're talking about breaking up Facebook. Maybe you have to drop WhatsApp or Instagram, even though they said it was okay for them to own Instagram. Now, Instagram is becoming so popular that now they're starting to worry about a monopoly and all of those things, you know, I mean, so they're going to be battling it out. So if they get to keep Instagram, right, it's going to blast to the upside. And if they lose Instagram, they're probably going to drop a little bit. So the idea is, I got a feeling it's going to either pop or drop, right? Well, I have a feeling they're going to be able to keep Instagram, and it's going to cause it to pop, right? The difference, you know, that's making me now lean towards the short put butterfly as opposed to what we saw with the short call butterfly is the short put butterfly. We have a directional assumption that it's going to pop or drop, but with the put butterfly, it's because you lean towards a put butterfly. Why? Because you feel like it's going to pop, all right? Difference with the call butterfly was we felt like it was going to drop more so. We still feel it's going to pop or drop either way. We don't necessarily care, but, you know, if you had a lean towards one or the other, and the lean in this case is to the pop, then that's what's going to shift you from the call butterfly to the put butterfly. It'll work in both, right? But ultimately, because our wings are short strikes, I want to get all of my strikes out of the money, right? Just to avoid some of the headaches that could go along with the assignment risk of a short put, right? Now, keep in mind that's not necessarily you know, a tragedy, because we have long options that we can assign as well. So keep in mind, when you are a buyer of an option, you have the right but not the obligation to fulfill the contract. In this case, if I'm buying a put, I have the right to sell somebody the stock, right? And if I'm selling an option, I have the obligation to fulfill that contract. So if somebody had bought a put from me, they could say, all right, you know what, you're taking my stock. Well, what I can do is I can take that stock that was just handed to me and just shift it off to somebody else and be like, all right, it's your bag. And it's going to work out the same on your profit and loss. I mean, minus all the commissions and stuff that you're going to have to go through. But it ultimately will work out because you're going to still have the width of where you sold it and where you bought it. That's still going to work out the same in your P&L, aside from some of those commissions. So ultimately, it's stuck in a range here. I think we're going to either pop or drop but I'm kind of leaning towards the pop, all right, on this one. So that's what's going to make me start leaning towards the put butterfly, right? So we want a movement outside of the wings. We do not want this underlying to stay in its current range. The last thing we want to do is have it stay right here and just get stuck in the mud. We need to have an outpaced move. Now, some of you guys might be wondering, well, if you want an outpaced move, then, couldn't you be looking at like the long straddle or the long strangle, something along those lines? Yes. Buying a call? Yes. If I was leaning toward bullish, right? You could do all of those things. One of the things that is going to differentiate this one versus the long straddle and having that outpaced move, if I felt it was going to go in one direction or another, pop or drop, if you were thinking that, one thing that would push me back towards the butterfly is, I'm a little less confident in that move, right? So with that being said, I'm kind of defining the risk. These short strikes are going to bring in my break evens a little bit and allow me to take on a little less risk than I would with the long straddle or something like that. So, long straddle, long strangle, you are expecting a big move, but this one you're expecting a big move, but you're a little less confident. So a great way to kind of, when you're wavering back and forth, just remember, you got to be really confident with that move on the strangle and the straddle. This one, you're pretty confident on it, obviously enough to make us trade on it, but you're just a little bit weary. It's been stuck in a trend. It's kind of back and forth, right? But I think that there's going to be a move happening relatively soon once we start getting more information out around Facebook. So obviously, with the roadmap kind of thing we're talking about, if we're starting out at around here, Sacramento, let's say, we're either going to go north or we're going to go south. But, we're heading into winter. It looks like it's going to be a good ski season. So we're going to lean towards moving to the north, hopefully. All right, the next thing we have to do is look at our Facebook page, right? We're looking at Facebook. I need to know if it's a good destination. Is this underlying a good underlying to trade options around, more specifically? So what I need to know is, when you're looking at a road trip, I just kind of drew my lines willy-nilly that we're going to go north, right? Well, I don't want to go, well, Idaho, actually, that'd probably be a good place to go for Sun Valley. But, I don't want to go to middle of nowhere in Montana. I need to make sure that there is a good destination where I'm going to go. And what I mean by is Facebook, does it have a lot of open interest, right? And, when I'm thinking about a destination, I want things to do, right? I want a lot of different activities that I can get my family to. Well, a lot of eyeballs are there. There's a lot of people. Same thing with options, is we need to make sure that there is, good open interest, volume and open interest in the underlying. So I have a specific rule for this. We're looking at Facebook in particular. Anything, if the stock is greater than $100, if we have a stock that, I'm going to say greater than $100, all right, XYZ is greater than $100, then I need to take my decimal, and move it 3 ticks to the left. 1, 2, 3, all right? So basically over here, we'd look at 1, 2, 3, and I'd be looking at 27, 28 cents. I'm going to round up. 28 cents. Less than or equal to 28 cents in the option montage. And we're looking at the spot month. And the spot month is usually the option contract that has about 35 days to expiration. Now, one of the things that I have here is the volume on here, right? You can see that there's a lot of volume on any given day. And I did this snapshot today of Facebook. So you can see there's a lot of volume if you flip over to this page. one thing I talked about at the beginning of this is I want to streamline your process to find the right strategy. So we don't even have to look at the volume thing. You can have your gamma, delta, theta option montage up where you don't have the volume and open interest. But if you do have a lot of volume and open interest, it will follow along this guideline. So we need to make sure between the bid and offer on these just out of the monies, just in the money, or at the monies, are following that rule. And you can see that it does follow that rule quite consistently across the board here between the bid and offer. It's definitely it's 20 cents, 20 cents, 20 cents, right? So that is less than or equal to that 28 cents. Now, if I were to pull up something like the platform here, let's see what, I don't know what I have up here already. Budweiser. So this stock is less than $100. So for something that is less than $100, less than $100 stock, like this one, we got a less than $100 stock now, XYZ, right? Less than $100. Then it needs to be less than or equal to 10 cents. All right. So even Budweiser, which I almost never trade, and it doesn't get a lot of volume, believe it or not, trading on any given day, has good option contracts. You can see that it's fitting that rule, quite closely. This one's just 11 cents. This one's a little bit wider. This one's 10 cents though, 10 cents. We can see that it's closely following that rule. Now, when we're looking at the analogy of a roadmap, if it fits my rule, and this one's kind of gray, right? You could say that that's a little bit of a gray area. We look at the stoplight mentality or analogy. And if it fits the rule, then it's a green light. If it's 2 times the rule, then it's a yellow light. All right? 3 times the rule, we want to stay away from it. I wouldn't trade options around it. It's just basically the bid offer is just too wide for that underlying. And that just means that there's not very many people in there making markets. There's not a lot of open interest. It's not a good destination, especially for a newer trader, okay? So walk away from it if it's like the red light. But I would say that Budweiser is kind of like right in between what this crazy, it's kind of right in between there, right? So still, I would say leaning towards the green light on this particular one. But, you can look at anything else. Bank of America, I'm trying to find something a little bit more. Philip Morris doesn't really fit that rule. So obviously I would be looking at that at least as a yellow light, right? I don't want to pick a Morgan Stanley. Less than $100, less than 10 cents wide to the bid offer. And this is during open market operations. That's another thing. Think we're after the close right now. These bid offers in the option montage are going to get wider. Why? Because as soon as the market closes, your orders are getting canceled. So look for this rule specifically inside of the day session, all right? We want to stay away from it outside of the day session. I know a lot of you guys are doing your homework after the close, maybe before the open, and you're trying to figure out different strategies to put on during the day or see how things are working out after the close. Make sure, like if you come up with your assumption here, that you check those, the option montage during the day session, 30 minutes after the open, because those markets will get tighter, all right? And then that's when you're really looking at this specific rule on being the right destination or the right underlying. We need to make sure that these options are tradable. I'm just trying to save you guys from a headache of trying to really determine pricing and everything else. And with this strategy, think about it. Earlier on I showed you there's like 4 legs to this strategy. If the bid offer is really wide, you're going to have to give up edges to get in and out of to get into the strategy. On the buy side, the sell side, the 4 different legs, all of those things. to get into this, all right? And then you're also going to have to give up that edge to get out. And that eats into our profitability relatively quickly, all right? So make sure they're tight so you can get in and out of these relatively easily. Now, what's the right environment? Now, what I'm talking about here is implied volatility, and more specifically, implied volatility percent, all right? I talked about implied volatility when we were in that option montage, but that I said that number 20, that's 26 doesn't really tell us anything. We have to know where 26 implied volatility is in relation to where that underlying has seen volatility, because what happens with volatility is it has a tendency to kind of, trade in a relatively tight range. Okay. Yes, it does break out to the upside, downside, but more often than not, it will have a tendency to stay in a relatively tight range. And I'll show you some examples as we go along, how we figure that out. So what we do need to figure out, though, is when low volatility, you think about it, there's no worries. There's no inclement weather. We don't have to worry about driving, all of those things. All we have to worry about is putting the top down on the convertible and taking our time when we're going to our destination. But if it was rainy, you definitely don't want that top down. And, the more inclement weather there is, if it's rain, sleet, or something like that, low visibility, fog, you're white knuckling it as you're driving along. Are you going to want to stop and smell the roses as you're doing that? No, you're going to want to beeline it there, all right? So the higher volatility, you want shorter duration. Low volatility, you want to take your time, right? You want to give yourself more time, meaning more duration in the option montage. When it's high volatility, you want a little bit shorter duration, all right? Now, I did mention that the butterfly has a tendency to break some of those rules. Well, this is no different. What we can see here is we're looking at the 45, right? Or the 41 here. That's telling us where Facebook's implied volatility is right now. And you can see right here on the chart, I got implied volatility. Now, I need to know where 41 is in relation to where this underlying scene. Now, we do have an outlier here, and you can see that we haven't gotten down there all of 2020 for the most part. So you have to do a little bit of internal search here, right? Or I say that this is out, all right? Why do I say that? Because that volatility spike is real, but the last time we got a volatility spike like this was in 1984. Before that, 1929. Not even during the financial crisis did we see this kind of volatility in the stocks, believe it or not. So to me, it's a black swan event. And if it's a black swan event, it means it's not going to happen for probably at least another 5-10 years. Maybe, in this case, it was, 35 years, 30 some odd years. So I'm kind of discounting that spike happening anytime relatively soon. Yes, we still are in this situation with the pandemic, but it's a little bit more clear as to what's going on here, right? At the beginning of all this, it would look like it was going to be decimating population, but not so much anymore. So it's kind of calmed down. I don't think we're going to see that kind of volatility again. Do I think we're getting back to 2020 volatility? No, I still think there's a lot of unknowns. The economy, whether or not these vaccines are going to work, all of those things are really going to keep volatility a little bit elevated here. So with that being said, I'm going to be looking at basically from here on in. And in that regard, I could see if, to ballpark it, you can kind of go like this. That was a bad drawing right there. Still pretty bad. I don't have a straight line there. But you can see that it's not super low, and it's definitely not near the high. So it's kind of medium to low, all right, where this dot is in relation to these dots there, okay? That's ultimately what we're trying to figure out. Right in the middle, that's, medium. A little bit lower than that, we're kind of talking medium to low. And why is this important? Because we can see that volatility moves back and forth, right? But it is staying within these range. If it were down here, you know, the idea is we believe that volatility is going to start expanding, or at least go back to mid-level, the median, and that's kind of, you know, the above water, below water mark. All right. Right now, it feels like we're a little bit low, low to medium. So what do we have? We have medium to low volatility with this particular underlying. This is another thing that is going to start making us lean towards the butterfly, all right? You know, long strangle, long straddle, we want extremely low volatility because we're paying for this strategy, right? We're paying for that strategy, and we really need volatility to expand to help us out. Well, with this one, you know, if volatility fluxes back and forth right here, that's not necessarily going to hurt us. But we definitely would love to see volatility expand a little bit. Why? Oh, I don't have that on that one. Well, I'll show you why in a minute. We want it to expand a little bit because why does volatility matter? When premiums are cheap, you know, you want volatility to expand because you're buying. When premiums are expensive, that's because volatility is high and we want that to come down, right? You would sell short and the volatility goes down, it affects those premiums, right? And the premium goes down. I've got a dog trying to talk to me. Volatility start going down, then that would help us sell high, buy low, all right? If you everything else you did was wrong, that would be working in your favor. So we try to exploit those different things. Just like, you know, we bought premium at really low volatility and it started expanding on us. Well, that could mean that the underlying was going opposite of our direction, but if volatility started expanding, it would help us, all right? So we try to take advantage of that. That's how you increase your probabilities. That's how you turn the table on trading options, you guys, is making sure when you set up these strategies, you're following these guidelines that I've come up with over basically 25 years of trading. I know when the right time to get involved in strategies and the wrong time. Why? Because on the floor, we didn't have the opportunity to pick and choose often. And I would know immediately that, you know, I was a market maker, both sides of it. And sometimes they would, you know, put it in their trades you didn't really like. I'd have to get mechanical. I'd have to start doing things to turn the tables into my favor. And a lot of this has to do with how volatility is going to react in and around that strategy. All right, so I'm trying to help you out here. So if volatility goes up, our premiums go up. And when volatility swings to the downside, we can see that that volatility going down, our premiums go down. In this particular case, we would like to see volatility expand a little bit. All right, volatility expanding will help us out, believe it or not. And usually I say when volatility is high, we want to sell premium. When volatility is low, we want to buy premium. Well, why is this off? You know, 99% of the time, this rule does work out. Well, because in this one, I'm talking medium to low volatility with a butterfly. The butterfly particularly does not react the same way. You know, we're buying two at the monies. And that being said, when we buy at the monies and the volatility expands, that's going to help us, right? Because if we buy those at the monies and they're being affected by volatility, just like Theta, more so than the rest of this out of the monies or deep in the monies, then that expansion on those ones that we bought will help us, right? Okay, that the ones we buy, we want those to increase in value because that will help us. All right, so more specifically, let's go into this and look at the implied volatility. We've already gotten our assumption. We need to really, for those people that want to see the math, you don't have to do the math. You can ballpark it. If you can draw straight lines like on your platform, it'd be a little bit easier. Actually, I could probably do it with this line. So like I said, if we looked at the, here, I'll pull this up. if we looked at this, like here's implied volatility percent, and this is about what I'm ready to tell you guys. And we looked at it for Apple, AAPL. All right, I have it over here. I have the strip to put in the watch list. You can see it's 22.85. That's implied volatility percent. I'm not talking about this number over here, okay? This number doesn't really tell us anything other than that's where it basically is currently, all right? If you do the math, like I'm going to show you, it's going to show up here and implied volatility percent here, okay? So we can see it's mid to low range here. But that also is including this outlier and this outlier, right? So that's how it comes up with the 28% basically, because it's saying the high here is about 88. The low here, low mark there, is going to be about 22, let's call it. And then 41, right? So something right around there. My math is rounding off. It's going to be right around 28%. Now, if we take all of that out, say none of this is going to, I don't believe that this is in the near future. See, that's why I don't want that pen. It keeps wanting to, wants to click on, it's got a little mouse clicker that I don't want playing with it. So I want to basically take this into account. So let's zoom in on that. So right here, you know, we're going to be talking about drawing a line there and somewhere around there. Let me get rid of that. All right, so if I'm going to look at this and say that's the high, now we're going to say the low is right around there, all right, for this implied volatility for Facebook. So that's what we're going to look at. You can ballpark it. You can see that the median is right around there, or you can go through and do the math on this. All right, I want to make sure I had the right one. All right, so we can say that the high is 60. I'm just going to make it an H. The low here is probably around 30, and the current is 41, right? So those are the key points we need. How to figure out whether it's between the high, the low, and the and where we currently are in that relationship. We take the current, for those guys who wants to dig into this, minus the low. You know, obviously this is IV, right? Take that sum and divide it by the high, IV, minus the low IV. Okay, so really all this equation really does is tell us where the current is in relation to the high and the low, all right? So in this regard, we would be looking at 41 minus 30, and then we divide that sum by the high minus the low, which is 60 minus 30, all right? And that being said, we can say that that's 11 over 30. So, you know, what is that? 34%-ish, something around there. So that's still medium to low, right? We could say that that's medium to low. I usually say medium to low is around 15 to 30, but we're just slightly outside of that. It's close enough for government work. You might say it's closer to one of those neon green lights. You know, if it was a 50%, there's better strategies. If it was an IV percent of 50, there's better strategies out there for this outpaced outside move that we're looking for. And if it was around 5, 10, I'd probably be looking at a straddle or a strangle for that because it's really low volatility. But we don't always get to pick and choose where our implied volatility percent is. Implied volatility percent really tells us what we're leaning towards, right? If it's really low, that means, why is this another reason why this is so important? If implied volatility percent was in the teens, that tells us that those premiums are extremely cheap for this underlying. If implied volatility percent is at 100%, that's telling us that those premiums are expensive. Now, do you want to buy something when it's super expensive? You know, like buying a new car, you drive it off the lot and you lose value on it immediately. Nobody likes that. We still do it, but we're doing this as an investment. Car, I would never say as an investment. It's more of a luxury item. But with that being said, when we're investing and trading, we need to know if we're getting something cheap or expensive, just like if you're doing multiples on a stock, right? You've heard people talking about that. The multiple on this is really high. That means that the price of the stock is really expensive, right? All right, this is the same thing. This is kind of telling us what our premiums are for this underlying. It's the only way to determine that, because right now we can see that the current right now is 40, and I'll throw up an example of, like, say, for instance, Tesla, because I know Tesla always just has super high implied volatility. But Tesla, let's look at, 103. What's the low last year? 35. That was last year, and I already said that I don't think last year's going to be in here. And 60 is the low for, Tesla. So we could say that Tesla never gets implied volatility as low as what we're looking at over there in Facebook. Okay. Why? That's exactly why we look at the implied volatility and figure out where it is in relation to what this underlying seeing, because that tells us if this was at 40, right? If this was a 0.4, we would know Tesla was extremely cheap in the option montage. So all of the premiums are cheap. Okay. So that's why that is really important to understand this in the option montage. Okay. Now, I have no problem with you ballparking it. It's going, where are we? Okay. It's relatively low. It's not quite as low. It looks like it might want to come off a little bit. Expansion will definitely help me in this strategy, though. Just know that. Okay. All right. So we can say, from all of that, we have medium to low volatility. All right, so we need to know that about this underlying. What duration are we going to look? Well, we got medium to low volatility. I'm going to need to know what type of duration we're looking at here. And specifically, we're going to be looking at the duration for a short put butterfly. I'm going to just put it out here, short put fly. The short put butterfly, you're going to want about 35 days to expiration. And that's the starting point. We're just trying to get as close to 35 days to expiration as we can. Sometimes it's going to be 30 days. Sometimes it's going to be 40, 45 days. All right. But that's kind of the idea when you're ever collecting a credit, which the short put butterfly, we collect a credit for. We want to limit the days to expiration, because a credit, if you buy something or you trade something and you collect a credit, that means you basically sold it, right? So if you sell something, you want the thief in the night, all right? So 35 days to expiration is what we're going to look at, because this strategy specifically is a collection of credit. So if we're collecting a credit, we want to limit we want to exploit theta decay. So when selling an option, or basically when collecting a credit on an option strategy, the trader wants to exploit that theta decay, all right? And that's exactly what we'll be doing with this particular strategy. And we can see that show up here. I can show you on the option montage as well. Further out in time, you'll see that theta number that we were looking at, I think was 6 cents or something like that in one of our examples. If you looked way out in time, 100 days out, it'd probably be like 3 cents. If you looked at like 8 days to go, it's probably closer to, 10 cents or 15 cents, okay? So we want to exploit the theta decay whenever you're collecting a credit. Out here, you can see it's a lot less, or a lot more time. Theta decay is a lot less. Inside of 35 days, we start getting that massive theta decay. All right, and like I said, inside of 7 days, that really drops. massively. And sometimes with this butterfly, you will have to kind of go in, you have to be in this one a little bit longer sometimes to get everything to work out. All right, so what vehicle do we use? Well, we're going to use that short put butterfly. I mentioned it a couple times, but what led us to all of this is the fact that we have medium to low volatility, right? I've got my directional assumption, pop or drop. First thing we ever come up with, pop or drop. Well, I think it's going to pop or drop. I'm not really sure how all this is going to shake out, but I'm leaning towards the pop. Again, if you were leaning towards the drop, you would use the short call butterfly. But just in my assumption, I'm leaning towards the pop to the upside. So that's leaning towards the short put butterfly. And we've got medium to low volatility. And that's the medium to low volatility, that little gray area there, is really what switches you over to the butterfly. All right. There's better strategies to take advantage of on extremes. I already talked about that. So the short put butterfly is the one we're using. And this is what we showed you at the beginning. This is what you'll find online, or they'll tell you do the at the monies, but they're not going to give you the in the money or the out of money. And sometimes people won't even do in the money puts. They'll do this entire strategy out of the money. That means your collection of credit doing this strategy is going to be minuscule to your risk, right? If you don't get the move you're looking for at the beginning, it's going to be extremely risky. So stay away from that. So with my rules here, we're going to be looking at the in the money put. There's a lot of different ways to look at this, okay? So an easy way to look at it quickly is the 90 put in the money, the 90 delta, or the 10 delta out of the money put. That's one easy way to think about it to get there quickly. And that will probably get you to the risk reward profile that we're looking for quickly. Another thing you could say is like 10% of XYZ is the width. All right. So basically what I'm talking about is the width is between these two or between these two, right? The width between here and here or here and here. Because they're going to be equal distance. It doesn't necessarily mean. So on a $100 stock, right, if this was a $100 stock, then, I would go from, these are going to be right around the 100 puts. Well, then the in the monies would be like the 110s and the 90s. That would be a quick way to get there. Another thing to do is this collection of credit, you can multiply it times 2. All right. A lot of ways to get to the same answer, to be honest. But the one that I usually look at is like that 90-ish delta. I do kind of cross-reference it with the 10%, because if it gets too far away, then it starts. The reason why we want to have medium to low volatility is because we want these really cheap. And if those are really cheap, then it allows our wings to be a little bit tighter. If these were really expensive, think about it this way. If it was really expensive, then our wings would be like monsters, off the chart kind of thing. If these are really cheap, you can think about it as being really skinny. So our wings don't have to be as far away. Okay. And that's why it's called the butterflies, because you got the double the base and then the wings. All right. No questions so far? So let's look at that example of Facebook that I came up with. Now, with Facebook, I'm looking at around that 50 delta. So you're not always getting a 50 delta, right? As you can see there, it's like the 52 delta. All right. The 10% rule would be about 28 strikes away. Well, you can see that this one's a little bit wider than that. All right. Got a little bit wider than that on the 28. We're actually looking at 45. But But when you look at it, at the deltas that I used, you know, that's pretty close to the 90 delta, right? And then the, what is it, the 25s that we use down on this side is pretty close to the 10 delta. Now you're saying to me, Wolfman, none of that stuff worked out exactly like you said. Well, it doesn't. I'm trying to give you guys streamlined processes to get to the end game quickly, you know, rather than going up here and dropping this thing down and getting the butterfly, which you can do. I never do that. I always build it out proper. Why? Because they're never going to give me the strike locations I want. So let's just go back to Facebook here. And I'll just go through this process with you. Let me expand this so it's not as confusing. All right, so I'm going to go to all on this. First thing we do when we're going through this underlying, right, is I came up with my assumption. Next thing I want to do is go over to the option montage. Move the decimal 3 ticks to the left, 28 cents. I need to make sure that 35 days to expiration during open market operations. Make sure it fits that rule. You can see that they've gotten really wide compared to what I was showing you on my screenshot, which is why I take those screenshots so it doesn't mess everything up. Now, keep in mind, we're buying the at the monies as close to a 50 delta as we can, right? $13.95. Now, I need to do 2 of these, right? Because I'm buying 2 of the at the money puts. Well, I click on that. You can see that it increased to 20, which I'm not going to do 20 of these. It just is defaulting to that. But you notice the price didn't increase. I have to know that that price is, if I were to do this, it's really 26 to 26 to I'm having a brain fart, 28 is the real premium. So doubling that is really why I have to go out to that a little bit further on this. Lower volatility would make this strategy work out a little bit better, right? That's why I want to lean towards the lower volatility. Why? Because the volatility coefficient on these at the monies affects these premiums more. So having said that, that's why these premiums, they're a little bit frothy, slightly, one could say. And that's making me make my wings go a little bit further out, more so deeper in the money, because that's where I'm really getting this strategy paid off. But I've got 2 of those. And then on this strategy, I went out to the, what was it, the 325s right here. Sell that one. And then I also went down equal distance. I went equal distance. I did the 80, so I went 45 to the upside. I got to go 45 to the downside. That puts me at around 45 to the downside. Brain fart. 25s. What's going on here? All right. 45 to the upside, 45 to the downside would be the 35s. Right? So I collect a credit. Collecting a credit on this strategy. All right, so it kind of put me at around that 10 delta there for $23.65. All right? I do all the math right there. All right, so then I have to figure out now my width of my strategy. As a matter of fact, that's why I think I went a little bit further out on that. I'll figure it out as I go. 325, 335, no, that, or 235, that's right. So now I've got a collection of credit here. The next thing I want to make sure of is, remember at the beginning, I need to make sure my risk reward parameters are right. I want to make sure that I am able to make one for every one that I risk. All right. So that's at a minimum. You know, if I can make more than I can lose, that's, you know, the cherry on top. Right. So, you know, the credit being more than 50% the width of these two is a good thing. And I said these are 45 wide. this is slightly more than 50% the width. So that's a good thing. I'm risking less than I'm able to make in this strategy. You don't want to do it if some people, like I said, would do, all right, let's buy 2 of those and then, do the 10% rule. What price did I, 25. So go 25 higher, 75, sell that one, 25 lower, sell that one. Now look at that, $25 wide. If anybody is ever telling you to do a short put butterfly out of the money or even in the money, it's going to work out very similar to this, where only thing I can make is $5. That's a max profit on this. And then I can lose $20. That's not a good risk reward. That's an iceberg. By an iceberg means my loss is so far down in the depths that I can't, your probabilities of making money are very slim. So I want to build it out like I have here, according to my rules, where I can make more than I can lose, which creates a situation more of like a boat. If I pull this up on the chart, you can see most I can lose is right around 22. I can make 23 to the upside, right? So I want this to kind of be a little bit more narrow. I don't want to see it where if I had high volatility in this case, this same strategy with high volatility would probably look something like, I'm just going to kind of ballpark it like that. If I did this in high volatility, well, that probably would have been a little higher. But that gets a little wider. Lower volatility, it starts getting narrower, all right? Lower volatility, we would see it more like that, right? So this is, we want it narrower because those 2 at the monies are affected by volatility the most. Volatility is super low. Those premiums at the money are about as cheap as you're ever going to see, right? So that's why we set it up that way. All right, so, but most importantly, when you're building this out, double check yourself. That credit needs to be more than 50% the width of the spread. You can think of it as well, all right? Everybody following so far? Everybody still awake? All right, so you guys got this. We figured it out, right? We've got a directional assumption. It's a pop or the drop. So when you first come up with that, then you need to start looking at these next ones. Is the destination okay? Is Facebook options tradable? I'm not sure if I'm spelling tradable right, but I'm just going to throw it in there for the world to see me misspell. And that has to do with that if it is less than $100 stock, right? XYZ is less than $100 stock, then we need the option montage to show us less than or equal to 10 cents wide from that bid offer, 35 days to expiration. And then if it's greater than $100 stock, we move the decimal. 3 ticks, 1, 2, 3, right? And then it's got to be less than or equal to whatever that number is. The environment, we want medium to low IV percent, right? IV percent, that's that range. We want it to be medium to low, all right? To fit this one. If it was super low will help us out, all right? If you got in when it was bargain basement cheap, that will help you out with this strategy. I would say there's probably better option strategies to go with for your risk reward than this one, maybe a long straddle, right? Because then you have unlimited reward to the upside or downside in a sense. So with this one though, it's medium to low, and I'm a little less confident of my making this big move outpaced, all right? So I want to limit my risks. Duration. For the butterfly, we went 30, right around 35 days to expiration is the sweet spot, all right? And we showed that. Why? Because we're collecting a credit. Anytime you collect a credit, you want theta decay to be in your back pocket, like literally just flinging money out, right? Because collection of credit, we want that to be able to buy back for cheaper, right? And then finally, the strike locations, we've got that. Basically, we want to get long 50 deltas twice. We want to get long two, we want to buy two at the 50 delta. I'll do it that way. And then we want to sell in the money 90 delta, and then sell one out of the money at a 10 delta. Okay, so those are our strikes. That's what we're kind of looking for. You can look at it as 10% or whatever this is doubled. We'll get you there quickly. The doubled's an easy one. Like, I mean, it takes a little bit more math, right? You got to kind of double it twice in a sense. Like if you had it, because it doesn't always show up and the pricing makes it a little bit funky. But that's it. Facebook, is it tradable? Move that decimal. Or if it's less than $100, like Morgan Stanley, we know it needs to be less than or equal to 10 cents. Environment. We've got our directional assumption, pop or drop. Why aren't we using one of these other ones for the pop or drop? Well, because we have medium to low volatility. We are a little less confident about our direction. That leans us towards this butterfly. And if we're leaning towards the put butterfly, we're leaning towards a pop more than a drop. If we lean towards the drop, we're going to look for that short call butterfly. Anytime we're collecting a credit, we want to exploit theta decay, strike locations, 90, 50, 10. Pretty simple. Let's go over our risk reward profile. Max profit, is that premium received? In this case, we were looking at $23 as our credit. That is the max profit. We can't make any more or less than that. Our max loss is basically just the width of the spread, right? I talked about in the money minus the at the money minus the premium. So basically it's the width. You can look at it as the width between these two, right? Minus that premium. We looked at the width. Ours was $45 wide, collecting $23 credit. That means my risk, my max loss is $22. So I'm able to make more than I'm able to lose in this strategy. And because we have a butterfly, we have two break-even points. Market could go up, the market could go down. But we need to know where our break-even is for both of those. And we're looking at the out of the money put plus that premium received. So in our case, we were looking at the 235s plus the $23 credit. That's where our break even is. The in the monies, we were looking at the 325s, I believe, 325s minus that 23 credit, 302 is our break even. May have misspoke there on that pricing. All right, so know your exit strategy. We need to know this before entering the trade, and I cannot emphasize this enough, all right? You guys always do this. Go through this process because you will stay mechanical. If you don't, you will be emotional. And because money is tied to emotion, we want to erase that. We want to look at this and be like probabilities and mechanical. This happens, we do this. If this happens, we do this. And the best way to do it is to write it down. That will hold yourself more accountable than kind of putting it up in your head. Because if you put it up in your head, you're going to have a tendency to try and squeeze this out. And I like to get in, get out, follow those rules, take the emotion out of it, never look back. All right. So we're looking at taking the short put fly. Whoops. All right, the short put fly, and we're doing the what was it? The 325, the 280, and what was it, the 235s? All right, so buy 2, sell 1, right? And this was the 10 delta, 50 delta, and oh, sorry, this is the 90 delta. That's the out of the money. Out of the money, 10 delta, in the money. Wait, 90 delta, 10 delta. Right. Nobody corrected me on that? All right, so on the winner, you know, I got so many things going on in my head right now. Win it. We got a credit. We're going to go at 50% of max profit on a winner. Get in and get out. All right, 50% of max profit. Another thing to look at is if it hits our short strikes, we are going to be there. That's going to work out. So you could even just look at it. If it goes up and hits the 325 strike, that is to me going to be, that to me is going to be where I exit. All right. Any of those short strikes, rallies up, hits 325, sells off, hits 335. I'm out on this because that is going to be very close, if not better than 50% of my max profit. With this strategy, we need that outpaced move. We get that outpaced move, hits those short strikes, think, hey, this is the exit right now. And you can write that down. If it hits the short strikes, also, you could say if it hit short strikes, I'm out. All right. Now, max loss, you could say if my credit doubled, well, that would be the full width of the spread. But I'm usually with this, it's because it's defined risk. I'm going to try and play that thing out to the end of the day. I'm going to be looking, because it's defined risk, squeeze this bad boy out, make all those things happen. For you, you could say, all right, you know, a 50% increase in the credit received, you're out. So if it goes from 23 to, let's say, 34 or something like that, you'd say, all right, I'm out, uncle. It's just stuck in this rut. It's not going to go anywhere. And I don't want to lose any more than that. So you can do both, either one of those. The main thing I want you guys to go with, you know, high risk tolerance. You're going to probably risk it like I do. Newer to options trading. Don't want to, you know, you have a low risk tolerance. Think about it. If my credit increased by 50%, I would be out. All right. So in this, I'm collecting $22 or $23. It increases and now is trading around 34. You know, I'm uncle. I'm out. I don't want to deal with it. Some people also, I have a friend that does time stops. You know, if it doesn't work out in like 5 days, based on the chart setup and stuff like that, then he's out as well. So I don't have a problem with that. I usually write him out. Okay. That's it. Everybody got it? Any questions before we move on so far? You guys jamming? All right, fine. Here you go. I'm throwing this out into the chat window. Here is your deal that we're going to be giving you guys today. Basically, it's a Wolfman's trading bundle. You could get all of it if you bought them all, broke it down. But with this bundle, I'm going to throw it out to you guys today for $497. So you're basically getting hundreds of hours of content here. Instant access to the most popular courses I've had. Those are the ones that seem to resonate the best with people. So we've thrown that into this bundle. You're going to be able to spot opportunities quickly and be able to exploit those by streamlining that process to getting to the correct option strategy. We're also going to be able to, if you watched all of these videos, you would be going from a novice to basically an option guru. You'd be able to probably teach your own classes. All right. Professional trader. We're going to show you what professional traders look at before they enter any trade. Also thrown in there is some trader hacks, other ways to streamline your process, things that, you know, like I talked about with Delta. I didn't get to all of those. You'll find those in there. Those are some trader hacks that we look at around Delta that tells us all kinds of different probabilities. So take a look at that as well. And how volatility works when we take advantage of it and much more. Basically, another breakdown here is in all of these courses, so you can see that these are the most popular courses that we have. all kinds of content in here. Here is the link. I threw in the hot link over there in the chat window, so you guys that want to take advantage of it today, get over there, hit on that link. Otherwise, if you're watching it, when we send this out to you, you're going to have to punch this into your URL. So take advantage of it because that's not going to last forever. Finally, I want to thank you guys all. Again, there's the link. Later webinars, I'll drill down on different option components, when and where I find them. If you have any questions, comments, or ideas for future webinars, reach out to us at 310-598-6677 or trading@protraderstrategies.com. Finally, know your risks before getting involved in trading. Yes, we have to throw our disclaimer up there. So please take a moment to pause and go over all of the risks involved in trading. All right, so there you go, guys. Take advantage of that bundle. It's a great one. You get 4 different classes taking you from beginner to guru. We start out small, easy stuff, build up, layer on top of it more and more dynamic strategies and ideas around it. Throw in some option hacks that you guys will help you with your daily lives. Thanks, OM. Appreciate your time. Appreciate your kind words. Take care. And that's it. Here's your deal of the day. I appreciate you guys. I hope you guys all took away something from this. That, you know, if you even got a little bit of nugget out of it, saved you guys from going out there and building out a short put butterfly like some other people I know will build that out, and that will save you for, you know, think about that. $497, you guys, is a $4.97 option. Okay, so that is a pretty cheap option. I can save you that in a matter of moments. That's all I got for you guys. We got the cameras up though. I'll give you one last shout out. If you can't take that, take it easy. Take care. Appreciate it, Alexander. Take care now. See you later. Bye. Bye for now.